accompanied by higher official cash rate, we start to have higher term deposit rate and higher fixed interest. Fixed interest start to yield higher. So could you maybe talk us through the common types of fixed interest investments?
Absolutely. Probably the most common ones that people would think about is money they've just got deposited in the bank. It could be a transaction account, cash account. On call, so that it's not locked in for any period, generally pays interest on a monthly basis, but often that interest rate's quite low. Then you have your term deposits, which are a fixed term with your registered banks, often between 3 months and 5 years. And as you said, Joyce, the current rates for particularly 6 months and beyond are kind of hanging around the 6% mark. Again, interest paid monthly or perhaps quarterly, and you get your money returned to you at the end of that term. You have non-bank deposit takers, so the same sort of thing, but they're not quite as safe in terms of their credit worthiness, and you expect a higher rate of return, so that's always a bit of a trade-off. And then you have private debt, which is another beast altogether, and the terms and conditions may vary quite substantially, including their peer-to-peer lending. So some of this debt's not secured against anything. Again, there's this trade-off, even within fixed interest of risk versus return. You just have to be careful how far you go down that path. And then the government and corporate bonds that tend to be listed on secondary markets, so you can actually buy and sell those bonds prior to their maturity, again paying interest on a quarterly or semi-annual basis. And then the last one being managed funds, where they may specialise in fixed interest. They are generally buying the government bonds, the corporate bonds, the debt issued by banks in any case. Now, in those last three cases, they are what we call price to market. So what happens is the value of those bonds will go up and down based on the prevailing market interest rates. Now that's quite different, for example, to a term deposit, because you can't trade a term deposit on the market. You simply deal with the bank. If you could trade a term deposit on the market and it was price to market, just like the government and corporate bonds and the bonds with the managed funds, they would go up and down in value based on prevailing market conditions.